Hello, everybody. Welcome to another self-directed IRA Saturday. Hope you've had a great Saturday so far. We have a great presentation today for you guys with our friend David Rosenburg. He'll be talking about private money. Yes, we're very excited about the content and we hope you guys enjoy it. Before we start, I'd like to go over some bookkeeping with you guys information. And then we'll get on with our presentation for the day with David Rosenberg. So just to get started here, I'd like to talk a little bit about Quest. So who is Quest? We're one of the largest self-directed IRA custodians in Texas, and I want to say in the country too. We currently have over 20,000 active investor clients across the country. 2 billion asset 2 billion in under asset administration, as well as 100 employees with 34 certified IRA service professionals. So we really strive on customer service and are proud of our highly educated staff. We also have about 400 million in undirected cash. So that's just a piece of information there for people who are looking to raise capital. That's what we're looking at right now. Again, before we continue, we always like to go through this disclaimer. Quest Trust Company does not provide any tax, legal, or investment advice. We also don't endorse any products, services, or investments of any type. All information and materials shared are for education purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investments. So what's a self-directed IRA? Basically, a self-directed IRA is a made-up term. We like to use it to differentiate the type of investing that you'll be doing, which is on the private side, alternative investing. But really, it's the same type of IRA under the eyes of the law. So what are some of the benefits I want to go over of having a self-directed IRA? Diversification, of course, very important to truly diversify. So you have investments and different types of markets, right? You have the public market, you have the private market, and it truly helps diversify your portfolio. Also, tax savings. Ask me how, but you can save taxes while investing through a self-directed IRA. You can also invest socially. You can invest in locally, or in companies that you believe in, that you want to support. You can also do that. It's a really cool thing about self-directing your IRAs too. And then also invest in what you know best and what you understand and what you feel comfortable investing. So that's really important too, and worth doing when you're investing through your self-directed IRA. So some investment choices that we see common through our clients, and we see our clients do on a day-to-day, I guess. Some examples are real estate, so single family foreclosures, commercial properties, condominiums, tax liens, etc. We also do see a lot of private entity investing in self-directed IRAs. So LLCs, LPs, JVs, oil and gas, cryptocurrency. We also see a lot of promissory notes, whether secured, unsecured, mortgages, convertible notes, and all that good stuff. Those are just some ideas, but really the sky's the limit. I like to say it that way. Because you can truly invest in everything and anything that is not traded in the public market. Some additional classes and webinars, guys, for those of you joining us for the first time. We do this every Saturday, these classes. We also have classes, weekly live classes every Tuesday. Basically same type of classes. We also record them and publish them in our YouTube channel, so you can catch them there as well if you miss any We also host a national networking happy hour once a month. I believe this month's passed last week. But we do like to do this so that we can have a bigger reach and so that you can have an opportunity to network with investors all over the nation. And then, yeah, like I said, if you miss a webinar or a class, you can watch it on our YouTube channel. We also host self-directed IRA socials. This is a hybrid experience because we do stream it on our YouTube channel and on our Facebook, but we also do it in person. So we have Houston, our head office, every first Tuesday of the month. In Austin, in our Austin office as well, we host them every second Tuesday of the month, and in Dallas every third Tuesday of the month. So those are also really cool experiences to actually go and meet in person with people who are like-minded, who are trying to do the same as you are, who are navigating the self-directed IRA world. There's also deal pitching there. So those are awesome opportunities to do. I'd like to also bring up our promotion of the month, Roth Rush. If you use this code, you'll get a Roth for free for the month of December. So go ahead and take advantage of this coupon. Also, this is something that it's ongoing, but referrals, we love our referrals. If you know anybody and you'd like to open an account here, just use this. You can use it an unlimited amount of times, and you get $25, and the person who you refer also gets $25 credited to their account. So really cool there. If you'd like to get in touch with me or any other IRA specialist here, you can live chat us. You can also call us or email us at iraspecialists@questtrust.com. So yeah, without further ado, I'd like to bring our friend David Rosenburg all the way from California.
Hello, everybody. Good morning.
How are you, David? Thank you for joining us.
Thank you for having me.
Go ahead. This is, take it away. It's all yours.
Thank you. Good morning, everybody. Thank you for joining us today. My name is David Rosenburg. I am the co-founder of Futures Financial. I've been in the business for about 20 years now, plus. I'm here today to educate you on the difference of private lending, hard money loans, and if this is an asset class that you might be of interest of participating in, would like to educate you, and so you have the understanding of what you'll be getting into, understanding the asset class, understanding what you need to look at, or who you're going to join with, or who you're going to invest in, and understanding what they look for and how they evaluate assets, and what is private lending and what is hard money. A lot of people always wonder what is the difference between both of them. As I mentioned, Futures, I am the co-founder with Kendra Rommel, my business partner, who's been in the business for 25 years as well. And we both launched Futures Financial. Today, I'm here to discuss private lending. What is the difference between private lending and hard money loans? Typically, a hard money loan is a private individual or a wealth of individuals who lend money to an asset locally that understand an asset class, and they will be lending to a piece of real estate. They will be lending to a building. They could be lending on land, but typically hard money loans are typically individuals who put cash together or use their own capital to finance lending for a borrower. Private lending is a little different. It's more of institutional capital, where it comes from Wall Street or private funds or equity groups who would lend on different types of asset nationwide and have a much bigger appetite on maybe the loan to value or CLTV or different type of asset classes that they have a bigger reach to than a private individual. Because a private individual has limited capital or so much capital that their comfortability is more in an asset class where they understand, or they're able to drive to, or they're able to touch, or they're able to see. Before getting into this asset class, I'd like people to understand or know private lending. What do lenders look at? How do we evaluate risk? How do we understand risk? Is it we judging a borrower? Are we looking on the asset? Are we looking on The collateral? Are we, looking at tax returns? Or what type of loans are we doing for these individuals to, and why are they coming to us? Obviously private lending, hard money loans on either one are typically higher rates and they're shorter terms. So why would somebody come to us rather than go to a bank or go to a financial institution? And this is what I'm going to be teaching or educating, or you having the understanding through this, through today, of if you are interested in this and who you're going to work with and understanding the asset class. Let me pull up a form deck now to where we can go over some bullet points, or what type of loans do we do, or how do people underwrite loans, or what do people look for in these type of classes. Let me pull that up. So the type of loans private lenders will do are typically a bridge loan, a ground up construction, a fix and flip, and a DSCR loan, which is really more suitable for the Wall Street and an institutional lender. The difference: a bridge loan is an asset where somebody or an investor will purchase to either A, go ahead and rehab it, and maybe put in a tenant in there to get it start cash flowing, so then they can go ahead and get a bank financing. This is a short-term loan that are offered between 12 and 18 months, and it's for an investor to go in quickly, not compete with somebody that might have to come in with a bank loan, which a bank will take anywhere, call it between 30 to 90 days to close, right? It's they're not as quickly as us. We only lend to investment properties secured to real estate in first position. These are non-owner occupied assets, and every loan needs to close in an entity. We also offer ground up construction. What is ground up construction? This could be a piece of real estate a borrower purchases and goes ahead and knocks it down and then rebuilds a new house. This could be a piece of land that a borrower purchased and they build a new house. They can build multifamily, they can build a residence, they can build 3 units. And typically, in order for any private lender, majority, they need to be shovel ready. What is shovel ready? Shovel ready is when the permits have been approved by the city and they are able to start construction on day one when we provide financing. A lot of these, then we have what's called fix and flip. These are a type of assets that a borrower will purchase. They'll go ahead and purchase the asset. They'll go ahead and rehab the asset and then go ahead and sell the asset. This is what's called fix and flip, and these are typically short-term loans as well, between 12 and 18 months. A DSCR loan is typically a rental program that is a longer-term loan, which typically hard money lenders, a niche of individuals with capital, will typically not lend on this because these are longer-term assets, which are literally hold for 30 years. So these are more based for Wall Street or aggregators who purchase these type of loans, which is much better suitable for them than a private lender, because a hard money lender, because they would like to be in and out of these loans quickly. Now, the reason why people come to us is because it's fast transactions. We all know today there's still a shortage of real estate. We still know there's a high competition of people trying to purchase these homes and buy these assets to go ahead and fix them, flip them. And we know there's a lot of capability of people having cash. So a lot of these borrowers will come to us instead of a bank so they can close quickly. And they are aware of they have to be out of our loans within 12 to 18 months. Typically, hard money lenders will offer an extension if the borrower is performing, they've never missed a payment, so we'll go ahead and allow extensions, etc. Now, we always want a borrower to have skin in the game. What do I mean by skin in the game? Well, typically, if someone's purchasing a house, we do not give you 100% financing. We definitely would like you to have at least 25% of equity, meaning funds you bring to the table to the closing. So that's what's called skin in the game, meaning you have risk now. You have an alternative investment actually in that asset, that you have liquidity in that transaction. So therefore, we believe that the more you have in it, the more you're going to protect that asset. The same thing if it goes with a construction loan or a rehab loan. You need to bring the funds to the closing table. So if you're on, for example, on a ground up construction, if it's the way we look at it or evaluate it, it's what's called loan to cost. What is loan to cost? Loan to cost will be the purchase price and the cost of construction combined together to add up as your total cost. We'll then go ahead and either lend 75% of the total cost or 70, depending on the area or the experience the borrower has. How many has he done? Does he have a history? Is he a first-time borrower? Has he done this? Is this a neighborhood he understands? So typically that would be based on, if he's going to bring 30 or 25% down, and they would have to bring all the funds to the table, which we control the funds. So as a borrower is doing construction, we then go ahead and advance the funds to them as they're doing the work. Now, these are the type of loans we lend. So now people ask about when you're going to go with somebody or you're going to invest with somebody, what type of loans or who do you want to work with? What are they looking for, right? How do they evaluate the assets? You're giving funds to a group. It could be, futures. It could be another entity that you might, invest in to do private loans, hard money loans secured to real estate and first trust deeds. So you would like to know and understand how they evaluate the risk. How do they review the risk? And what do they do to mitigate the worst case scenario? I always like to make a joke is we understand how we're giving somebody money. We understand how we're doing that. But my biggest thing is how are we getting out of the loan? How are we getting our funds back to our investors? How do we get our capital back? To always understanding what is the exit. We always understand going into a project. And what I mean by that is a lot of individuals will come and provide the documents, we'll order reports, appraisals, etc., which I'll go over with you in a second on risk mitigation. But we would like to also understand, what is your exit? How are you going to get out of it? Will it make sense for a bank to exit you out of this? Are you going to need to sell the property? Do you believe if you rehab the home and you're going to go ahead and put it on the market, is it really worth what you think it is? Are you, we always believe that borrowers believe their assets are worth a lot more than if you go to the public market to put it for sale. So therefore, we always want to have an understanding of what's the exit price. Is it a bank loan? Can you refinance with a bank? So that is how we evaluate to make sure we look at our exit. Now let's look at the screen you might see on your computers now that is risk mitigation strategy. What we do to prevent risk, underwrite files, to protect our investors' capital and make sure we get our returns in. So typically, on every single asset, we run credit reports on every single borrower. We run OFACs, and OFAC is the history background of anything associated that you've been with, and we run LexisNexis as well. So these two reports will literally tell us anything you've been associated with on any single entity. Have you ever been foreclosed on? Have you ever had bankruptcy, debt, lawsuits, anything to do with an individual or entity that you're associated, we'll be able to pull this. And this is how we judge a borrower, or we understand a borrower. On every single loan, we'll do an appraisal. Not only do we do appraisal, we do what's called a secondary review on the appraisal from the company we ordered the appraisal from to make sure all numbers are in matching in a line order, that we believe this is the value, as we do it internally as well. Now, if we're doing a ground up construction or a fix and flip loan, we'll then go ahead and order an as-is an appraisal and what's called an ARV, after-market repair value. What is the value of this real estate once it's been rehabbed or constructed? We need to know what that value is, because that is how we determine on the loan if it's the day one funding or total funding as we're going through draws as the borrower is developing or rehabbing the asset. Now, why is the ARV value important? Because this is what's going to determine and help us value what is their exit value. Is the purchase price realistic? Is the sale price realistic? Will someone buy this asset in this neighborhood? Is it the most expensive house in the neighborhood? Is it the cheapest house in the neighborhood? Or is it just the medium home price range that we know it's going to sell? Or is the borrower looking to hit home runs, meaning they want to be the highest sold in the neighborhood? Typically, we don't like that because we want to make sure our assets get sold and left as we're the lender, right? We want to always make sure to lend and get our capital back. One thing also on values is we review comps. The market is constantly changing. We're in a different time today in today's market. So Futures, we're constantly evaluating our guidelines. Typically we would look at appraisals, let's call it with comps within 12 months or less. Since the market has changed tremendously, now we review comps 6 months or less. So what do I mean by that? I don't want to see a comp of a real estate sold or a comp that's on the market that's been sitting on the market 6 months plus or sold within 6 months plus because of the changing market. Values change, markets change, sales change, holding patterns change. So we're constantly moving to review that. Also, when we're reviewing appraisals, we want to make sure that the distance of the assets that we're evaluating the real estate in is no more than more than 1 mile or less. Why is that? Because neighborhoods can change from block to block, from mile to mile, and are in different neighborhoods, and we prefer to have anything in a mile or less. Now, if there's a comp that's outside of a mile, there has to be a reason for it. Maybe there wasn't any multifamilies in that street or in that neighborhood, or it's a different piece of asset, or it's there's just maybe it's in the Midwest, or maybe there's not as many comps in the area, or maybe there's not so much movement in the area that we're unable to find comps within the mile or less. What we typically also do on every single asset, we do 120. We do title insurance, and we typically get 125% title insurance on all our assets to protect us from fraud or altered documents on maybe an operating agreement, or maybe a signature that was not someone's signature, or falsifying documents. So we get what's called the highest insurance, which is 125% title insurance on every single asset. And we always will use, and you always want to make sure when you're evaluating other companies, you want to make sure they're using a reputable national title company, because today you don't need them. But when there's a problem or an issue and you need to go file a title claim, this is very important to make sure that the title company that you're going to go back to file this claim is still in business, and it's not a mom and pop shop that is not going to be able to fulfill the need of the title claim because they don't have the liquidity or the funds to go ahead and fulfill that situation. So we always make sure to use a national brand when we're using title. Other things we like to review when we're personally doing our loans is there's so much with internet fraud, and there's so much cyber going on these days, and alter documents, and so now when we get verifications on bank statements from a borrower, we also run through a third-party company to validate these statements, which is called a VOD, verification of deposits, that come directly from the bank, so we can confirm what the borrower provided to us, as well as what's currently in their bank matches, average for average, or dollar for dollar, or the dates. They all make sense. One also things we always do is anytime prior to us closing any transactions, we always we have another company called Funding Shield that reviews who we're sending our wires to, vetting the title company. Since we're a national lender, we're working with attorneys in other states. We're working with title companies in other states. We're working with escrow companies in other states. We want to make sure they're property licensed. We want to make sure they're in good standing. So we have a company that vets all of these transactions, confirms all the wires, confirms their license is intact before we send any funds to any third party for closing, to make sure that the transaction gets to the funds get to where they need to get to. We also, back to appraisals, we always use licensed appraisers. We use third-party companies, so we're not choosing the appraiser. We want to make sure that it's someone that gets picked out in the neighborhood, who understands the area. We don't want an appraiser who's lending, evaluating a piece of real estate who, lives 40, 50 miles away from the real estate, because they don't understand the asset. So you want to make sure you have somebody in the area who's reviewing this piece of real estate for you and providing you comps or values, etc. The typical type of loans also that we lend on, or a lot of individuals lend on, is multifamily, single family residents that are non-owner occupied. Remember, these are non-owner occupied loans secured to real estate in first position. My opinion, I love the debt structure. I love first trustee loans. I feel it's as there's a risk in every investment you will do. I feel being in the debt side and lending on first trust deeds, I feel the security and it's less risk because you have so many different avenues to do something with an asset. If you're working with a good company, someone you could trust, someone that understands the business and understands how to mitigate through situations. Because I always tell my investors or parties that I work with that, listen, you judge somebody when something goes wrong, right? If a borrower is always making a payment, there's no problem. But what happens if a borrower doesn't make a payment? What are your rights? What are you allowed to do? What options do you have? Well, being that we're in first position and we're secured by the real estate, we have the right to foreclose on a borrower if they're not making a payment. The number one I tell someone, if you ever work with a company such as Futures or someone that like us, that you invest for first trust deeds, how do they get at these assets if there is a problem? And there's foreclosure. There's also where you can sell a note. There's also how top of their servicing are they? The number one part of this business, in my opinion, is servicing. How on top are you on your assets when a borrower misses a payment? Are you in contact with that borrower? Are you working with that borrower? Are you finding out what's going on with that borrower? Or is it just another loan in a mill that you're hoping that the borrower makes the payment? That, hey, I'm going to believe in the system and we're going to foreclose and it's going to take, 120 days to get a sale date, or it's going to take 180 or 200 days, and we're just going to let it go through the system, right? But throughout that time, is the individual or the group that you're working with understand what needs to be done? If a borrower's not making a payment, they're probably not paying taxes. You want to make sure the property taxes are current. In certain states, property sales tax happen very quickly. We can then wipe out your debt. So you want to make sure your property taxes are current, especially in certain states that they have sales on taxes quickly. Every state is different. Timelines in every state is different as well. Now, not only that is, if a borrower's not making a payment, do they have insurance? They're probably not paying their insurance as well. So if that's not the case, you want to make sure you put forced place insurance on this asset. Now, the forced place insurance only helps a lender. It doesn't typically help the borrower because all we are protecting is our asset. We care about the structure. We care about the collateral because that is what is securing our debt and that is what is protecting us. So we'll go ahead and put forced place insurance on the asset. So now our property is insured. God forbid there's a fire. Maybe there's a flood. Maybe there's vandalism, or maybe the borrower, the tenant, whoever is in there, because these are non-owner occupied, and the tenant might be angry. And when they vacate that property, they might demolish the interior. When times are bad, there's a lot of people that take out copper plumbing. So we have forced place insurance to protect our assets, so then we can go ahead and re-put the plumbing in or pay, get title and get insurance to go ahead and fix our asset so we can do what we need. While we are foreclosing, we're constantly simultaneously possibly working with the borrower. Maybe they have funds that they didn't know about that they can pay off the loan. Maybe they have different avenues they can go and reach out to somebody to pay us off. We are also constantly working with other note buyers where people are looking for these assets, and we are able to trade these assets to other mom and pop note buyers who are interested in what's called non-performing debt. So these are borrowers, like I said, who are not making payment, and there's a big marketplace out there that they're looking to acquire these non-performing debt, which are typically known in the field called NPLs, non-performing loans. When we get the asset back, while we're in foreclosure, prior to getting the asset back, we reevaluate these assets. If we take it back in foreclosure, who's buying in this neighborhood? Is it a family? Is it, is Airbnb hot here? Or is it an investor neighborhood? Do bachelors buy in this neighborhood? If we take back this asset and we go ahead and, clean it up, paint, how much are we selling it for? What's our exit price? What is our quickest way to get out of this asset to make sure our capital is back for investors? Everybody's making their returns. Is that how quickly can we get out of it and bring it back to our investors? Now, if we ever take back an asset, we're never going to hold the highest record of high sales in the neighborhood. We promise you that. we are not in the business to set records for neighborhoods, highest sold in the area. We're typically there to get our assets back, return our capital, and keep writing good loans, making sure our investors get their fixed return. What other things do we look at when we're taking assets back? Is how secured are we? Mentioned that. What realtors are we working with? Do they understand the neighborhood? When we take an asset back, you got to make sure you have your locksmith ready to rekey the property, because you don't want squatters getting in there. You want to have a cleanup crew that comes in there and takes out any trash or anything that's in there that tenants left behind. And you want to get that property up and going as soon as possible to get at that on the market. I also believe when we take back an asset, which is huge, is if you put something on the market and you don't get offers within 30 days or less, you're too price high for the market. Doesn't matter, good market, bad market, there's always buyers out there looking for real estate. So if you don't get multiple offers in the first 30 days, you're priced way too high. And we are not looking to set records. So we'll go ahead and reevaluate that listing price so we can get it back. Other things when you're evaluating different groups, do they have an understanding? How long have they been in the business? Do they know good markets, bad markets? And once again, it's my belief in this business. We understand how we give loans to borrowers, but my belief is how is the exit of these loans? And it goes back to selling the real estate. It goes back to can they refinance with a bank? Do they qualify for a bank loan? What is, and you should ask these questions to other ones. What's your average FICO score across your portfolio for your borrowers? Or what's your average loan to value or your across your portfolio? How risk is your portfolio? Are you lending at 90% across the books, or are you at like a 70%? Are your average FICO scores 600 or your average FICO score 700? At Futures, we're happy to say our average FICO scores are 700 plus, because these are bankable borrowers who need to move quickly. And the reason why they come to any private lender or hard money lender is because they need to move these transactions very quickly in order to get the asset, put a tenant in there, remodel it, so then they can go ahead and get a bank loan. I don't know at this time if anybody has any questions, or if anyone might have questions for me at this time.
Thank you, David. That's a lot of great information. So yeah, like you mentioned, we at this point would like to open up the floor for some questions. So if you guys have any questions, you can put them in the chat, and we'll ask David here. I do have a couple of questions, actually, David,
Absolutely.
myself. Well, I let our viewers also ask the questions, but so I kind of want to ask on the borrower side, and then also if you want to also share with us on the investor side, if you guys also do that. But first, for the borrowers, actually, first, where do you guys lend? Is it like nationwide, or is it specific states?
Yes, we're a nationwide lender.
Okay.
So yeah, we lend nationwide, every state. As I mentioned previously, every state's different on loan to values, or foreclosure timelines in certain states, or so we weigh that into on everywhere we lend, on timelines and risk.
Okay, it actually looks like, thank you. We have a question here from Christy. Thank you, Christy. Do you recommend the same for an investor to investor loan? I'm not sure I understand the question. I was reading it wrong. Are your recommendations the same for an investor to investor loan?
So do I recommend an investor that has capital to invest in loans? Am I understanding the question correctly?
I believe so, yes.
I absolutely recommend, if you do have capital sitting on the sidelines or have cash that you would like to invest in, I do recommend you going with an expert who understands the industry, and investing that capital to get a fixed return, which I believe is much better in today's marketplace and much more secured. So yes, I do recommend you invest.
Awesome. And that actually leads me to a question I had on the investor side. What do your investors look like? What are you guys looking for if someone wants to invest with you?
So we're always looking for investor. A lot of our we're always taking new on investors. We work with a lot of family offices. We work with private wealth. We work with individuals. All our capital at Futures Financial comes from wealth offices, private individuals. Is where our capital comes from. We don't use bank capital. So our goal is to make everybody around us stronger. Better people's lives. Provide income to individuals and giving them a chance to become the bank and lend on these assets. And that's our number one thing at Futures is letting people have the opportunity to become the bank and lending to people.
Awesome. Really well. Really good. So going back to the borrowers, what's your pre-approval process look like?
So when a borrower needs a loan, we're not an asset. We're an asset-based lender. So as I mentioned, we don't take tax returns because we understand people do different things with their tax returns because a lot of our borrowers are self-employed. So typically what we do is, we're an asset-based lender. So typically when the borrower is interested in a loan, they'll provide us with, the address, the purchase price, what they're purchasing. We'll go ahead and do some internal comps real quick to make sure the numbers or the valuations make sense. And then from then we'll go ahead and they'll submit their package. They'll fill out an application. We'll go ahead and run credit reports, run OFACs, we'll order appraisals. And then if everything checks out in the beginning until the appraisals come back, because that's when we determine the LTVs or the values on what we're lending, right? Because a lot of these borrowers think, they're going to buy this today for, $1 million. They're going to put rehab and sell it for $2 million. And then we'll get these appraisals back and valuations in certain neighborhoods, and they come back like 1.2 or 1.3, so then we have to rework the numbers for the borrowers. And our number one thing is, as we do with our ground up construction and our rehab loans, we're typically working with the borrowers and we get feasibility reports for them and making sure the numbers work for them, because at the end of the day, we want to see our borrowers succeed. We want to see our borrower get to the end and sell the project so they come back and get another loan from us. And our last thing is to go and lend to somebody that we don't believe that they're going to have the capability of finishing the project and exiting the project. So we'll educate a lot of these borrowers as well.
Looks like we have another question here from one of our viewers, Robert. If you're looking at being there it is. If you're looking at being a new lender, should you be more concerned with the asset or the borrower?
That's a good question. Your number one thing is the asset. I always make a joke, the borrower is going to be the problem. What I mean by that is if the payments are not coming in, the borrowers obviously have rights, so it could be foreclosure. And foreclosure is a timeline. And then you can, it takes time. So you can get to the end and have a foreclosure sale date, let's call it tomorrow. The borrower does have a right to file bankruptcy. So if a borrower files bankruptcy, now you then have another timeline, which can take anywhere from 45 days to 120 days. Because when a borrower files bankruptcy, everything stops. Can't call the borrower, can't deal with the borrower, can't talk to anybody. So it's literally a frozen. But being that, we, if Futures or who you invest in, should be in first trustee in the first lien position, secured to an asset, we then have the rights to file what's called a relief from stay in the bankruptcy, to which can go ahead, pull our asset out of the bankruptcy and continue on with the foreclosure, because we are a secured debtor on the asset, so we can take our lien back, our asset back.
Awesome. Another question for new investors: what's the initial investment to qualify for? What are the terms? Do they have to be accredited or non-accredited?
Yeah, we us at Futures, we take credited investors, and we every investor, we work with you one-on-one, or if you come from a group or a party, then we'll go ahead and obviously we do fixed terms. Our terms are typically locked up for 3 years, with option to extend for year 4 or 5. And the reason why we do this personally is if at the end of year 3 and the capital is due back to one of our investors, if everything's performing, we definitely will never unload a portfolio for a loss. So just to get investors' capital back. So that gives us the ability to start moving assets, assign assets to different groups, or if we need to move it to close out a fund or a group of investors, we'll go ahead and start moving the asset. But typically, they're locked up for 3 years with us.
Okay. And then that leads to this next question. Do you operate as a fund or are you a broker for individual loans?
We operate as a fund. We do not do individual loans.
Okay, perfect. Thank you, David, for that question. We have a David in the viewers. I'm actually going to leave here in the chat your email address, David. Oh, we have another question here from Moda Plata. What are your typical interest rates to the borrower?
And today, it's changed tremendously since in January to April to today. It's constantly moving. So in today's market, typically our average rate to a borrower today is anywhere between 10.5 to 11.5% to an average to a borrower. And this all determines on if it's, we have credit boxes, a future. So it all depends. Is it cash out? Is it, ground up construction? What's your credit score? What is your experience? So we have different tiers that we evaluate on our credit sheet on determines your rate. But the starting rate is typically 10.5% today.
Okay, thank you for that. What do you feel like is going to be an appropriate interest that will be attractive to borrowers and still lucrative for lenders as we transition into 2023?
I believe, private lending is different, like I mentioned. So people are coming to us and our rates are higher. So, from the 10.5 plus 11, 12, but they're coming to us for an opportunity to get this piece of real estate. There is still a shortage of housing worldwide. So there's still housing necessary for borrowers or individuals to move into. So, and there's still investors everywhere that are currently looking to purchase these real estate and, then go ahead and fix them and put tenants in there, which will still bring them the strongest returns as, and have collateral and appreciation for these investors. So I still going into 2023, I think it's going to be still very strong for investors who have cash to purchase real estate.
Thank you. And then we have another question. How does your fund get the return on investment when the borrower puts a tenant in the property?
Well, all of our the borrower needs to make the payment either way. Tenant, no tenant, we need to make sure you get our monthly payment. But typically, the borrowers, we review bank statements, right? So we make sure they have, reserves enough to qualify to, sustain a loan, and that, they have enough funds there to make the monthly payments before they even get the tenant in there. But if there's a borrower or a tenant in there or no tenant in there, making payments or not making payments, or if they're remodeling or whatever they're doing in the situation, they still need to make their monthly payments. We don't stop the monthly payment if they don't have a tenant in there. One thing I want to mention also, I apologize, is you do have a right as a lender. Let's just say a borrower goes into foreclosure or into default, or we do have a right as a lender to go ahead and then assign the rents to us so we can start getting the rents from the tenant instead of going to the borrower. So you do have that right. Now, there's one thing you need to understand about that people don't understand is if you do take that over and you start taking the rents, you become the landlord now. So now they're going to call you for everything, a broken toilet, they need some light bulbs. So you do have the right, but sometimes you got to wonder if it's a good or bad thing to do sometimes.
Right. Do you have a focus on real estate and or note investing?
Do I have? I love real estate.
Probably.
I love notes. I love real estate. I love debt. Now, I prefer debt over owning real estate at the moment because we're getting into the asset at a lower number. So, if we're typically, let's just say if we're typically lending 75% in today's market, we're coming into that asset class with some security. So God forbid if we ever need to take that asset over or if we're closing, we already have equity into it, right? So we're already technically getting it at a lower dollar amount. Also, there's so many different avenues to get out of if you own the debt. As I mentioned, foreclosure, sell the property, note sales, transfer it, work with the borrower, right? You'll be surprised. Borrowers, if they're in a desperate situation or in a need, they're going to find money to pay you off. They're going to call family, they'll call somebody. So I feel you have so much more to do with debt side than just owning the real estate and not having to wait for one person to buy that piece of property. Or, is someone actually going to buy it, or you're just sitting on it, or the market turns. I just feel you have a lot more to do with the debt side.
Interesting. Yeah, so I think that concludes our session here. Thank you everybody for your questions. They were really good questions, and thank you, David, for joining us and for sharing with us really cool information about private lending. Yes, thank you.
Thank you for having me. I appreciate it. Everyone have a great weekend.
Yes. I hope everybody has a great day, great weekend, and see you again next time.
Thank you very much. Have a great weekend, everybody.